big hello, welcome to RJ Sanderson TV. It's our October edition, a jam-packed edition at that. Roy Sanderson, as always, is here. Welcome, Roy.
Thank you, Dave. Good to be here again.
Hey, Roy, heard some breaking news as I came into the studio on the way here today. Carrie Bickmore.
Yes, I understand that she has left the project after 15 years or so. And I asked the question, is there any truth in the rumour that she may have left the project to join the panel here on RJS TV?
Oh, geez, that would be an absolute bombshell if we were to land her, Roy. So there's a question for you, Carrie. You're going to come on RJ Sanderson TV. Hopefully, we can land her in one of our remaining episodes for the year, Roy. But how's the mood at the moment within your sector, within the tax sector, within the economic sector at the moment? Because there's a little bit of there's plenty of news going on, which we're going to get to shortly. What's the general mood?
General mood is a little bit of nervousness, I think. There's a fair bit going on. We've got a budget that people are worried about. We've got high inflation. I think we'll talk about property later. Rents are going up. There's concern. We've still got more interest rates to go up. So, yeah, there's a bit of nervousness in the market, Dave. Let's
get into our news headlines and have a look at how some of those numbers are manifesting, starting with the interest rate. Roy, it has gone up, that interest rate, and we can see that it went up 25 basis points to 2.6%. Now, this was below the expectations. So expectations were that it would go up 50 basis points. And this kind of irked the market a little bit, and it was a bit of an unexpected decision.
Certainly was. I don't think there was any experts predicting 0.25. I think everybody was saying 0.5. Interesting, I think the Reserve Bank may do another 0.25. There had been talk that if we go too hard, too heavy, then we might slip into a recession and therefore interest rates would come back in 2023. And it might be the Reserve Bank are just trying to soften the approach a little bit.
It's interesting. We spoke to Tony Sarai on this program last episode, Roy, and he mentioned that the market kind of absorbs changes that are predictable. So any time that there is something that happens that is unpredictable, such as only 25 basis points as opposed to the 50 basis points, things happen. And we're going to have a look at the stock market in a second, but a slight correction there in September, and it sort of adds to that narrative of uncertainty, doesn't it, when things happen that weren't predicted?
Yes, exactly right.
Speaking about predictions, inflation expectations are still quite high at the moment, up around the 5.5% mark. So we can see that there is still an outlook of very high inflation, and there is some important data to come out of the US later today after we finish this show that is going to be around that inflation number, and the world will be watching as they're expecting the inflation rate in the US to be up around the 8%.
Yes, and this is certainly one of the major concerns for most individuals and businesses around Australia. And we'll see a little bit later that there's plenty of factors that are going to be forcing inflation up. But it's interesting where it's at right at the moment.
The Australian dollar has declined to a 2.5-year low, Roy. So you can see there on your screen that it's at around the 62-cent mark when compared against the US dollar, which is an interesting graph. Experts suggesting that it is due to stronger than expected US jobs data that's pushing up the value of the US dollar and creating inflationary issues over there. But also it's, I think, to a certain point, when there is uncertainty, people turn to cash. And what is historically the most secure cash? It's US dollars. So it's pushing the US dollar up as well, and as a consequence, the Australian dollar falling.
And their interest rate has been increasing at similar rates to Australia, and not as soft as 0.25. So again, it's attracting a lot of money to the US. And that graph there supports the fact that we'll have higher priced imports to Australia, which is going to push the inflation rate up as well. So it's a double-edged sword, isn't it?
So many challenges for policymakers. The 10-year graph of the Australian dollar, it's interesting to look at where it sits in comparison. And if you have a look there, you can see that 2.5-year low, so the lowest it's been since kind of April 2020. The last time it dropped off worse than where it currently is was at the start of the pandemic. And again, that's that narrative of uncertainty. So when there's uncertainty, people turn to cash and when they turn to cash, they turn to the greenback. So, you know, I think that this idea that things are not over yet from the pandemic is starting to really hit the global markets. We're seeing uncertainty in the UK as well, which is impacting things. And I mean, no better time to look at consumer confidence. I know that we're probably going a little bit out of order here on our rundown, but consumer confidence is a graph that we look at all the time on this program, Roy. And as you see here, it went up in September. Now, a moment of indulgence. We did predict that it would go up, but it has since weakened. And I think that, again, it's that kind of, are we there yet? Are we out of the pandemic? No, we're not. We've still got high inflation. We've still got high interest rates. We've still got, you know, Russia and Ukraine at war. There's still some factors contributing to this.
I agree. We did predict, we're allowed to say that, we did predict it would go up. We got that right. It has levelled back down a little bit. I think the future, it's going to level out, be very close to where it is today. Unless something happens that gives us a bit more confidence in the future. And it might be the budget that's to come out in the near future.
We've got some good thoughts on that coming up. Bill Evans, the chief economist at Westpac, said the index remains in deeply pessimistic territory. So you see there that economists, you know, sort of recognising the fact that consumer confidence level is at a very low base currently, based on its historic numbers, which can only mean one thing, Roy. The only way to go is up. So hopefully, once some of these things start to resolve themselves and policymakers start to figure out this post-COVID reality that we live in, we'll start to see things level out. Let's have a look at business confidence next, because again, the two indexes tend to go hand in hand, and you can see there business confidence also dropping, still in the positive territory, and still some strong retail sales growth that is helping that sector, but yeah, still a slight decline in the business confidence index as well.
Yeah, it's a decline, but it's still in a positive state, which is somewhat surprising to me, given how low the consumer confidence is. So, interesting.
Job advertisements sort of flows into both of those, consumer confidence and business confidence. And you can see here, I thought we'd have a quick look at this 10-year graph, Roy, because you can see that it's still at quite a high level in comparison to where it's been. It's at historical high levels or near enough historical high levels, which means a couple of things, Roy. We've still got labour shortages because people are putting the ads out. And if we are to fill these job ads, we're going to have inflationary pressure.
Yeah, well, labour shortage is actually means that people having to pay more money to get the labour and employ people, which is adding to inflation as well. So there's lots of pointers here that keeps pointing to we've got inflationary pressures. All these stats are pointing to high inflation right at the moment.
We mentioned the stock market earlier in the show and the uncertainty that sometimes comes with decisions that are unexpected. And there's the correction in September that you can see there. It was sort of starting to, to head up at the end of August, early September, but then quite a significant correction in the market. That's not pertaining to the interest rate rise, I might add, or the unexpected variance in the interest rate rise, which came at the start of the October month. But probably, analysts suggest that came off the mini budget that happened in the UK that created some uncertainty in the global markets.
You look at graphs from the view of getting a historical look at where the market's at, and you look at that 1 year graph, and you would say to yourself, maybe now's not a bad time to talk to a wealth manager and get some guidance on what to buy, because the market will turn around. It doesn't stay where it is forever, and we've had a bit of a bad year so far this year, so that 1 year graph indicates now might be a good time to buy into the share market.
Well, we've talked about on this show, you can invest in the stock market, you can also invest in property. Generally, they net out similar returns over a long period of time. So let's have a look at some of the property market data from CoreLogic. And Roy, you can see there the annual change in the home value index is interesting.
It is, given that South Australia over the last 12 months has been extraordinary, and you look at New South Wales and Victoria in the capital cities, and we're down. but up in the regionals across all markets across Australia. So it's mainly New South Wales and Victoria that are suffering on the home value index over the last 12 months.
And mainly just the capital cities, Melbourne and Sydney, really the regions across the board look to have increased in value annually. So interesting stuff there. The median value is the next graph that we've got there, and again, you can see that median house price in Sydney. It's just off the charts, isn't it?
Yeah, and it's interesting to see where is the most expensive place to buy property at the moment. It is still Sydney. Canberra is quite high as well, with limited sort of space, I suppose. But yeah, that graph is just to show you what you need if you're going to buy into a capital city.
Quarterly changes is the next graph that we've got, and this one's over a 5-year period, Roy.
Yeah, isn't it interesting that over the last 5 years that our quarterly change has been, for the first 2 years it mostly hovered pretty level in Adelaide and Brisbane, but Melbourne and Sydney were dropping and then jumped up and then dropped and then jumped up and have now dropped. And again, we're probably from a house price point of view at a low point, and this probably supports that. How much further it will go down, at the moment it feels like it will keep going down because there's nothing to suggest it will go up, but historical graphs suggest that it might turn relatively soon.
Leah Calnan to join us on the show very shortly, which is always a fascinating and insightful discussion, Roy. But ahead of that, we've got an interesting graph here on finance, because you can see that the amount of applications for finance, particularly in the investor space, has started to really decline.
And this is a real concern, and we'll talk to Leah about the rental market and rental increases are up around the 10% mark. And as an indication of that being a problem, the amount of people who are applying for finance who are going to be an investor having dropped 11%. Compare that to 2016, there was a small gap between the owner-occupier and the investor, and right now there's a huge gap, which tells me we're going to have a problem on the horizon where we have less rental properties. And that's a real concern, because renters need to live somewhere. We need to have investors, and the investors seem to be leaving the market at the moment. Yeah,
it's a generational problem, isn't it, for policymakers? And clearly there's no easy solution on the horizon. But I know that you generally come to this show armed with a problem and a solution, and it's time to hear that problem, because it is time for our favourite segment, Roy's Rage. Roy, what's got you fired up this week?
So what I'm annoyed at, I'm going to take a dig here at the federal government. Now, I don't necessarily agree with the tax cuts, but the tax cuts were announced by the government of the day some time back. They were supported at the time by the opposition, who's now the government. They were supported and confirmed leading up to the last election that these would not change. Now they are leaking the information that they look like they need to change them. I thought I would just mention that the rates that we're talking about is the band from 45,000 to 120,000. That rate changes from 32.5 to 30%, and the 120 goes out to 200,000. What it really means is a person who earns 200,000 is going to save tax in a year of $9,075. I thought I would just check, Dave, with how many taxpayers that affects. From the statistics I could get, there's 286,000 people who earn 200,000 or above in Australia. 286. So that's kind of cost $2.5 billion, which is why the government's now saying maybe we shouldn't make this change.
So your rage there is against the fact that the government may go back on an election promise. What would you say to the argument that economically things have changed since they made that commitment? And do you think that strong leadership is being able to change decisions, or do you think it is to stand by election promises?
It's a tough call, isn't it? Because I believe that if you go to an election and make a promise, you should stand by it. I believe that wholeheartedly. They did support this. They actually voted for this to become law when they were in opposition. And I think it's the broken promise that would annoy me, because it means that you cannot trust politicians when it leads up to an election. That's the bit that would disappoint me. Whether it's a right or wrong policy, I won't argue with, because I would argue potentially we're not targeting the right people. 286,000, I'd be looking at lower income earners for tax cuts.
Save that for a second, because as I mentioned, you're someone who comes armed with a problem but also with a solution. You're not just complaining. So Roy, we put the task to you. If you were the Prime Minister, what would you do? What did you come up with?
Well, the first thing I would do is the low middle income tax offset. That has already gone. That disappeared on the 1st of July 2022. So the next tax return, we don't get that extra $1,500 that we were getting this year and last year, and prior to that it was $1,200. I would make that a permanent fixture on our tax scales. I would then make all education tax deductible, irrelevant whether it relates to your current job. And I believe a smart country is a better country, and promoting education I think is awesome. Right today, if you're unemployed and you decide to go out and do a course to become an accountant or a plumber or whatever, you can't claim that course as a tax deduction because you're not working in that industry. That's wrong. Just make all certified or accredited education courses tax deductible. And my final suggestion to the government, and I know this will be controversial, I know it won't get acceptance, but it's me as an accountant, I think we should have GST on everything, because when GST was promoted as legislation, the opposition of the day many years ago, back in 2000, had to negotiate, and they pulled out certain things that have no GST. Fresh food, medical, bank fees, education, exports, sale of a business. Now, I know that means that people would spend more money on fresh food. Today, you pay GST on a chicken that is already cooked, and you buy chicken and chips already cooked. You pay no GST on the chicken if you buy it from Coles or Woolies and it's not cooked because it's fresh food. So just put GST on everything, but to compensate taxpayers, change the tax-free threshold from $18,200 to $30,200, which will have a tax saving of $2,280. That's going to give more people more money in their pocket to be able to pay GST on some of these costs that they may or may not spend money on.
So you're essentially arguing for a simplification of the GST system?
Complete simplification. The courts are filled with cases, and accountants, we fill our pockets with money because we are supporting arguments with the tax office and in the courts about GST-related items. It would just clear that as not being an issue anymore. 2025,
Roy. That's the next federal election. I reckon you've got a run in you. Is there a campaign in the pipeline?
Vote 1, R. Sanderson. No, I can guarantee you, and there's a reason I can never run for politics, and that is when I'm in business, my business aims for 100% satisfaction. A politician aims for 50.1% satisfaction. I could not live with that. I wouldn't sleep at night.
Well said. Well, one person who is a great friend of the show and always brings us some fantastic insights is Leah Calnan from Metro Property Management. We've got her on the line now. Leah, welcome.
Thank you. Thank you for having me.
Leah, we're hearing a lot about the uncertainty within the rental market at the moment. There's speculation that prices are going to skyrocket in the short to the near-term future. What's the latest with the rental market at the moment from your perspective?
Yeah, look, in circumstances with regards to vacancies and increased rents, it's definitely happening on the ground. We're seeing properties increase by, in some suburbs, $50 to $100 a week across Metro Melbourne. There are still some pockets that aren't having such a high level of demand or such a high level of increase. But overall, it is a very, very tight rental market, nothing like I've seen before.
Leah, what is the factor or the main factors that are driving these increases in price?
Look, it's actually a couple of different factors. The first one is that investors really slowed down their purchasing over the last 5 to 10 years. And we know that we need to have a continual flow of, investments coming through, whether it be building or investors being able to buy. The introduction of the Residential Tenancy Act and those changes that came in nearly 2 years ago, we warned government when I was president that this is potentially what was going to happen. We saw a lot of investors exit the market through COVID. So the added cost and the added financial strain on these owners has been unbelievable. So, it's a combination of a few different things.
We're just seeing a few of the slides that you sent through, Leah. So you mentioned some of those supply issues and the changes to the Residential Tenancies Act. You know, you guys, as a board of the REIV, have obviously come up with certain solutions for these situations. What are some of the, I suppose, aspects that you're lobbying the government, the state government, about at the moment?
Well, unfortunately, the Andrews government has said that there'll be no changes made to the Residential Tenancy Act, which is very disappointing. There's a lot of compliance aspects that really need to be reviewed and, potentially overturned. There's some practical elements. We're seeing confusion out there in the marketplace on what meets compliance and what doesn't. The opposition is certainly, we've had discussions with opposition with regards to having further review of the legislation. But things like, a perfect example is the introduction of an annual rent increase. In practical terms, that seems to be okay. But what that means and what that has actually meant in the last, nearly 3 years is gone are the days of $5 and $10 a week rent increases where you could do those every 6 months. Now what we're seeing is $20 and $30 a week rent increases, taking place on an annual basis. So in some ways, the Andrews government for the people that they've actually been trying to protect and assist, they've actually caused financial stress and rental stress for many of them.
In terms of the solution to that, you mentioned that you work with the opposition as well. Is it heading into an election? You must be disappointed that there hasn't been any changes made.
Yeah, absolutely. There's certainly been a stonewalling from the Andrews government for some time, which is certainly frustrating. And, this supply aspect has been going on for years. If we look at, I don't think it's on one of the slides, but from an affordability point of view, most property managers will be assessing whether or not a renter can afford a property based on a 30% of their income. There's so many less properties available now, so there's so much pressure on the private rental market to be actually supplying, social housing or more affordable housing. But that's actually not their job. That's the Vic government's job, and that's actually the Fed government's job. So until they actually fix that problem, there's going to continue to be a huge issue in the private rental sector.
Leah, just before we wrap up, one final question. You work with other stakeholders outside of the government, and clearly this is such a broad issue. As you say, there's well-meaning policy that's being put forward that hasn't worked, and there is clearly upward pressure on prices. Who are some of the other stakeholders that you think need to get involved in these discussions? Because as you say, it can't all come down to investors. Who are some of those other stakeholders?
Well, actually really should be starting at government level. We know that they need to be supplying about 20,000 properties per annum to be able to assist with that affordability aspect. So it really needs to start there, and then that flows through to the different cohorts that make up the rental market. Unfortunately, from a private rental sector, there really is only, your traditional mum and dads. And the part that often people forget is that the average investor owns one property, and that sits at about, 78% of properties that are owned by one person. So unless they change things to superannuation and they look at putting different options available for investors in a larger scale to do some things like they do overseas, the strain is going to continue for some time here.
Some fantastic insight as always. Leah, thanks so much for joining us on RJ Sanderson TV.
My pleasure. Thanks for having me.
Thanks, Leah.
Leah Calnan there from Metro Property Management. Some really interesting insights there from Leah and essentially suggesting it's got to come down to a whole of government solution.
Yeah, some of the slides she sent through were quite exceptional. There was one that suggested that the number of rental listings right at the moment is 20.5% less than what it was 12 months ago. And that means there's less properties on the market right at the moment. And the number of potential renters is down as well. And new listings down by 7%. So the stats are saying we have a problem on the horizon.
Yeah, and I think that that problem is absolutely going to be there until there is a very holistic solution. I know that the regions are struggling with this issue as well. There's a massive supply shortage. We think there's a supply shortage in capital cities. Well, that's even worse in regions. It affects tourism, it affects staff. It really is quite a complicated problem. and it's one that should be on the radar of the state government and the federal government.
And we saw a graph earlier where prices in Melbourne and Sydney had gone down in the capitals, but actually gone up in the regionals, and that's partly due to people shifting from Melbourne City and Sydney CDBs to country areas, which has pushed prices up there and created vacancy rates. So it's quite an interesting problem we have economically right at the moment.
Roy, uncertainty around, and there's also uncertainty around whether we may be joined on the panel by someone else. We mentioned off the top Carrie Bickmore. Have you heard anything?
I've just checked my phone. I haven't had a message from Carrie yet, but you're certainly welcome, Carrie, to join us on rather than the panel, on the project. We'll call it the panel.
Well, it's been a fantastic episode. Roy, thanks so much for joining us. We got one more this year in us?
Yes, we've got one more to go.
We've got one more in us. So make sure you join us next time on RJ Sanderson TV. Thanks for joining us tonight.